Okay. All right, I'll start her up, everyone. So, on behalf of the CFA Society Winnipeg, welcome to our first, or not our first, but I believe this is actually our fourth virtual speakers panel. This event is called the Value of Real Property, a real estate panel discussion. So my name is Vivek Maharaj. I sit on the CFA Society Winnipeg Programming Committee. Now, CFA Society Winnipeg, as many of you know, has served the Winnipeg investment community since 1952 by promoting ethical and professional standards within the investment industry. Our society is an active participant and innovator within our international organization, the CFA Institute. We're also a member of the CFA Societies Canada, which promotes advocacy efforts to our regulators. And CFA Society Winnipeg provides our members with professional development and educational opportunities, job placement services, and membership networking events. So the size of our registration list today, I think, is a testament to the interest in today's topic of discussion. I'm sure no matter what your role or field is, you hear regular questions about real estate investing. Everyone wants to get involved. And 2020 has kind of turned the world upside down as we've seen rates got slammed to near zero, there's unemployment skyrocketing, and real property prices continue to show volatile and mixed results depending on where you're looking. We've also seen a shift in our environments that's kind of caused us to question the value of office and retail space going forward. Meanwhile, industrial or warehousing space has seen kind of a speculative boost. And so, we've been hearing it kind of all over our lives for the past 8 months, but we really are in the midst of changing and unpredictable times. But fortunately, we've got an awesome panel of experts with us today to lend some clarity to the misconceptions and offer their views of real property now and in the future. So we'll have some time for Q&A towards the end. Feel free to enter your questions in the chat box, and we'll see if we can work our way through those in the latter part of our discussion. So our first guest, I'll just go through and give everybody a quick intro. Our first guest is Dennis Mitchell. He's the CEO and CIO of Starlight Capital. And he joined Starlight in 2018, but he has over 20 years of experience in the investment industry, including serving as SVP and Senior Portfolio Manager at Sprott Asset Management, and as EVP and CIO at Century Investments. Now we've also got Don White with us. He's the CEO and founding partner of Private Pension Partners here in Winnipeg. And in that capacity, Don provides overall leadership and a strategic direction for all aspects of P3, including sourcing, developing, or redeveloping, and then actively asset managing commercial and multifamily built for rental assets in Canada on behalf of P3's family office, pension fund, and institutional investors. We've also got Jimmy Shan. He's partner and portfolio manager at Slate Securities. Jimmy's been in the equity research and investing space for over 18 years. He's also spent time as managing director at GMP Securities, providing coverage for Canadian publicly listed real estate sector. And last but not least, we've got Joshua Varghese. He's VP Portfolio Management and Portfolio Manager at CI Investments. And Josh has been with CI since 2006. He's been specializing in real estate investment management since 2011. And he currently co-manages the largest global listed real estate fund in Canada, which is the Signature Global REIT Fund, as well as CI's Global REIT Private Pool and ETF. And he co-manages Signature's high income and diversified yield funds and assists in managing the real estate allocations of Signature's equity and balanced funds. And of course, moderating the panel today, you all know James Burron. James is the president and co-founder of Canadian Association of Alternative Strategies and Assets, or the CAASA. James has also been the COO of IMA Canada. He's had roles in institutional sales, fund of hedge fund structuring, as a product manager, and then as an investment advisor. So lots of background there. So welcome back, James. Thank you very much to all our guests for making the time to join us today. And James, I'll pass the virtual mic over to you.
Great, thanks, Vivek, and thanks also to Brendan and Sid and Eva, who's in CFA Society, for making this happen. This is great, and I'm missing an opportunity to go to one of my favorite airports in the world because the taxi's the shortest, and from the gate to the door to the outside is the shortest also. I love it. I love coming over there. So, but sadly, we have all four of us, except for Don, are over here in Toronto. We're not quite braving the winter yet, but we'll you guys have had your intro, so let's go into a bit of background. Maybe we'll start with Dennis and what you've been seeing in your area, the areas that you're in. It's multi-res and a few other things. Maybe give us a bit of background to your activities.
Sure. And so I'm fortunate that CBRE actually had an event this morning where they gave yet another sort of periodic update as to what the property market looks like across Canada. Speaking specifically about multi-res, the first question that everyone has been asking consistently since the pandemic hit is, of course, rent collection. And so comfortably, we can say that rent collection across the sector has averaged 96, 97%. Okay, and that is, and people have been playing interesting games with those percentage numbers. Is that 96, 97% of your rent roll or of your normalized collection rates? And so I think in this case, it's 96, 97% of actual rent roll. Now, what we have seen is that rent collection has actually been higher, the higher up you go in terms of price point. And so when you start thinking about who's been impacted by COVID-19, you start looking at sectors like hospitality, tourism, and so you start thinking of who's been laid off: waiters, waitresses, flight attendants, personal trainers at the gym, Starbucks baristas, and you start, reverse engineering what their income level would be, and as a result, what rental price point they would be at. You can see that skews to the lower end of the spectrum. You put that in context with somebody who's first or second year law student, or somebody who's preparing for the UFE, or an equity research associate, giving Jimmy Shan now nightmares about his past. But if you start thinking of people in those careers and professions, and you start reversing engineering their income, you can see they skew to the higher price point in the rental market. So what we've seen overall from coast to coast is that the strong fundamentals going into COVID-19 have really benefited multi-res. Vacancy of less than 2% across the country, less than 1% in the major markets: Vancouver, Edmonton, Toronto, Calgary, Ottawa, Montreal. Some weakness tied to the shutdown of immigration, foreign students not coming in, slowdown in household formation as students start thinking about whether they want to spend all their time in quarantine in a 5-bedroom home with mom and dad, or if they want to spend it in an 800 square foot box downtown Toronto. But this is obviously short term. COVID will be with us for a while, but eventually we'll get through it and the fundamentals will resurface. In the meantime, interest rates have gone down to the point where you can get 10-year CMHC insured money at 1.6%. So that erases a lot of mistakes you might make on the valuation side and allows you, if you've got an existing portfolio, to refi debt and push it up to make up for any cash flow shortfall that might occur through some vacancy weakness or short-term rent weakness. So all in all, the multi-res space is extremely robust. Large institutional investors continue to pour money into the space. We continue to see private transactions, and really COVID has not had a material impact on the private market from a investment standpoint, from a valuation standpoint, and from an outlook standpoint. So we're pretty content with what we're seeing right now.
That's a pretty rosy picture. It's when you said Starbucks baristas, I thought, wow, this is a real crisis. They're getting laid off. Let's go global with Josh. Josh, you got a purview of Canada and the world. So what are you seeing? Is there any bad news out there?
Yeah, there happens to be a little bit of bad news. I'd say what we're seeing in Canada is pretty similar to what we're seeing globally. The story is pretty much the same. Vivek highlighted it at the beginning, where we're seeing this divergence between the haves and the have-nots, and it's really up in the air as to how you define haves or have-nots. And how I'll define it is, if I were to simplify into financial terms the change that I perceive right now, it's that discount rates are changing. And if you think of two parts to the discount rate, one being your lower risk-free rate, but then the second one being your equity risk premium, that's the one where we're seeing it vary across the board. So we can all agree, the risk-free rate is the risk-free rate. That's coming down all-time lows. Where do you find yields? That type of thing. But then when you go out and you try to forecast your models, and that forecast was based on a previous set of assumptions that I think in a lot of asset classes kind of get thrown out the window when you think of, one, where vacancy is going to end up, two, where CapEx is going to end up, three, where leasing rates are going to end up. How do you peg that equity risk premium? So then you start to see sectors that have those biggest question marks take the biggest price hits in the public markets anyway. So, hotels, malls, offices. You see companies like this down, 30 to 60%, depending on the asset class. On the other hand, when you get into some of the other asset types like warehouses, data centers, cell towers, cold storage facilities, life science offices, you can actually get a much better picture of where incomes are going to go, because you can look to see where in-place rents are. You can see how that compares to market rents. You can identify the tailwinds behind those market rents. And so to me, it's no surprise that those asset types are holding in very well. And then there's, that in between where the markets, in the public markets anyway, have kind of come in and decided one thing, but the private market is saying something different. And that's an example like multifamily, which Dennis has mentioned, where everything about the narrative can point to something negative. What we're actually seeing is something pretty positive, and you can make the case just because of the shortage of housing globally in certain areas that rents should hold relatively well. And even if they come down, if you're in a type of asset class with rents that are significantly below market, you're in a good asset class considering that interest rates have come down so much. So I'd say that it's a divergence that we continue to see, and it's not just real estate. We're seeing it through equity markets in general, where the new world sectors like tech, software, mobile are doing extremely well, and some of the other ones that are maybe caught in a stagnant environment can't really catch a bid.
And then Jimmy, you straddle both of those, public and private. So what kind of sort of disconnects have you seen in your portfolio and opportunities, that type of thing?
Yeah, thanks. Great to be here. I would agree that there's definitely a big bifurcation between the winners and losers. From our perspective, shall I say, we're a little bit more tilted towards value, which is a pretty bad word today. And I'm also a little bit more skeptical in kind of what we're seeing. So I just see a lot of uncertainty. And I think what we're trying to balance, at least what we're trying to do in-house, is how do you not overpay for what looks to be a crowded trade in the winners category, but also how do you not overpay for an asset that looks cheap, but in the end may become obsolete. So it's a bit of a balancing between those two acts. And the sort of, if you look at the sort of the, what Dennis and Josh have outlined in terms of what's going on in the different asset classes, I would say underpinning everything is this whole idea that today density is the enemy, right? So downtown cities like New York, or if you look at the asset class that have been the hardest hit, underpinning all of that is the fact that we cannot congregate. And so I can do math. I could try to underwrite a real estate asset, but what I cannot do is science. And I think science is the root of all of what's going on today. And I think it will have an impact in when you're underwriting any asset. But to your question about the difference between public and private, in the private market, it's volume is really low. I mean, I think price discovery is not there yet. There's price discovery maybe in certain asset classes, the asset classes that has the most certain outlook. We're seeing some transactions, multifamily, we've seen industrial, but the asset classes where there's a lot of uncertainty in terms of what the future cash flow would look like, there's no price discovery. So if you overlay what's going on in the public market versus the private market, I think what you're seeing is that the public market seems to have priced in a lot more decline than what seemingly looks to be in the private market. But I'm not sure you can categorically say that, hey, the public markets is really cheap, let's go and buy, only because the private market is going to lag, and I think we're going to see some of that come forward. So that's kind of what we're seeing, and what we're trying to do is figuring out which asset classes are we seeing the biggest difference, and are we comfortable buying that risk?
Thanks. We'll catch up with you on the asset classes in a second, but let's go to Don, who's very much in the private side. So what have you guys seen in the highly liquid side of redevelopment and just private transactions, especially in Winnipeg?
Yeah, for sure, James. Thanks for having us. As a regional asset management and development player, I think we are a bit different, as we do get to see some of the development side of things. And as Jimmy just said, we are preparing for more disruption Specifically, we've had great opportunities the last 5, 6 months in our private REIT to find some arbitrage on our balance sheet with the cheap debt. So we've been a big player in taking down as much of that affordability financing through CMHC. And we've been very fortunate that we've been building in the last 6, 7 years. And so those projects either under construction or recently completed, there's been a nice uptick for us. The other place we are seeing some disruption is in the casual labor market. So construction costs, we do think they're probably headed upwards. As an example, landscape and crews across Canada, when you have programs like CERB and the expanded employment insurance benefits, we have seen a lot of trouble finding some of that lower end, but very important casual labor market, the students. So we're certainly keeping an eye on that. Like Dennis's and the other portfolios we're predominantly multifamily rental, built for rental. And so we're about 80%, very, very high collections. Our street front commercial though has also been very strong. And so our other 20% of our portfolio is what we call tactical street front commercial. And we've been getting new deals done, as I would say the entrepreneurial side of Canadians comes through and people looking to redefine themselves. And lastly, I do think we're going to see some disruption in existing buildings. We're seeing it already in our market and some of the other markets we're looking at as we grow geographically. And by that, I mean existing buildings. COVID and this pandemic is changing the way people think about how they live and work. And so old buildings that don't necessarily have the HVAC people demand, the cleanliness they demand, the space they demand. We're seeing quite a bit of demand. We've got one relatively large commercial development site that we own with a big pension partner here in Winnipeg, and we are seeing very, very strong interest in that as people rethink how they reuse space. So something that I don't think that gets a lot of talking about, and back to Jimmy's point, I do agree that there's a mismatch right now in the public sector and the private sector side of things. And I do believe that entities like all of those on the panel today, we are going to find some really exciting opportunities in the existing product, as maybe in some of the sectors, oversupply of new product starts to find its way in. And we'll be watching for sure. We will be watching construction costs, because labor costs, as everybody knows, a huge element of that. And if people don't get back to work, labor costs, we all seen what's happened with the price of wood, might happen to other components of a building. So disruptors we think are on the market. So you're going to have to be smart and tactful navigating your way through.
Great, thanks. Well, let's keep it local with Dennis actually on the Portage Place development. What's the update there? You knew that was coming. Oh, you muted it. There you go. Nice.
So I did know this was coming. I'll be very careful here. Let me start by saying that Starlight Investments is very, very excited about this project. It's 550 residential units, a couple of towers, office and retail components, and a significant public space initiative. So we're very excited about that. We've got a waiver date of November 27th by which to complete due diligence. So we're grinding away through that due diligence, and so far so good. There's a lot of local stakeholders who have made clear their opinions. So for everybody on the Zoom call who is from Winnipeg, we hear you loud and clear.
Oh, yes.
Yeah, and then I would say the city and the province have been fantastic. City of Winnipeg, province of Manitoba have been fantastic in supporting this project. We'll deal with the feds on another day. But this is an important redevelopment project for the community. It's very important to Starlight Investments. We're excited about being able to go final in waive conditions and break ground. So that's as much of an update as I can give you at this point. But if we do this again on November 28th at least, we'll be able to give you a little more color.
Great, thanks. Hey, on that, I don't know if it's too early, but on the zoning and all the back and forth to local and provincial governments, has that changed at all during COVID for you, or for maybe for the other panelists too, or has it just been like normal things, like they're just doing it business as usual?
Yeah, so it's definitely not business as usual, and this is where relationships come in. If you're initiating a new relationship with someone over Zoom, I can tell you it's not nearly as impactful as if you're leveraging a multi-year, multi-billion-dollar relationship and track record over Zoom. So that's where, being one of the largest residential landlords in Canada with over 40,000 apartment suites from coast to coast, That's where that comes in handy. I won't say that we've got the same depth of relationships as Don, but we do pretty well.
Cool. We'll go back to Jimmy. What's the sectors you like from your purview in public and private, and are they different?
Yeah, I mean, look, I think, so going back to my comment about how there's not a whole lot of price discovery in the private market, I think if we were to make a call today, it would appear that the opportunity, in a big sense of the word, is in the public markets, right? Because look, the Canadian REIT sector is down at something like 25, 26, 27% year to date on a price only return. The US is a little bit less than that. Where, however, when you look at some of the asset classes that have been really hit hard, it's higher than that. So if you look at in the past, Canadian, whenever the sector have sold off that much relative to private market values, the public market tend to be directionally right, but maybe exaggerate the return a little bit more. And so I'll just give you sort of an example. Like if you look at pre-COVID to today, the price decline of the REIT sector relative to the earnings revision from March to today, what you'll see across almost all asset classes, whether that's in Canada or the US, you'll see a much greater decline in the REIT price than you would the earnings. Now, you can make the argument that maybe there'll be further earnings revision, 12 months from now, but it's a pretty sizable margin. But what's more interesting is if you compare that earnings revision relative to the REIT decline versus the broader index, and you see that's even much more pronounced. And so, there's multiple reasons. And I think Josh touched on this in kind of the game that we're playing in the public markets, is this whole idea of this tug of war going on between splashy growth momentum type stocks versus value, which REITs are in today, right? So this tug of war between growth and value, I think, is kind of being exaggerated today, and that's why, and then when you think about factors that are like ETF, for instance, I think that's also playing a bit of a role. I mean, I don't know if a lot of people know, but the REIT sector, especially in the US, the ETF is a big player in that space. And when you think about the decision rule of an ETF, it's quite simple. Money comes in, you buy; money comes out, you sell. And so you have to guess where sentiment is. And when you guess where sentiment is, that's effectively headline news, narratives, and all kinds of biases you can think of. So when people are working from the office, when every one of us is working from the office, it's very easy to think, gee, I don't want to be in office. And so that to me is exaggerating the price decline. That's why we're seeing this greater price decline in REITs versus the earnings, which again leads me to believe that in the short little while, the opportunity is in the public markets. Now, in terms of which asset class, again, it goes back to the earlier discussion of, well, what kind of risk do you want to take? The two questions we ask a lot is, especially in the trouble sectors like lodging, hotels, office, and seniors housing, is what is the permanency of these trends, number one, and two, if we don't know what the permanency of these trends is, and if we have to guess, are we getting paid to guess, right? So we can buy the asset classes that are trading in with big tailwinds, like the data center stocks and the single family rental stocks or asset classes. You buy them and you're probably gonna have to settle for a lower return initially, but with probably steady and continued growth. Those you can buy probably for unlevered returns of 3.5%, 4%, 5%. But if you want to take a little bit more risk, then you could start looking into lodging, hotels, strip centers and malls. So it really varies. And there the question is, you can buy them for 8-9% unlevered returns, cap rate, but you have no idea what that future cash flow is going to look like 2 years from now. So what we're doing is we're sort of taking a more of a balanced approach to Josh's point, and that's sort of that middle ground. And And the apartment sector does look pretty interesting today, especially in the US for us, given the price decline and what we think to be non-permanent issues. So that's kind of where we're spending a lot of our time. And the other thing I should say is this whole density question, the death of cities and the New Yorks of the world. We're spending a lot of time there, but doesn't mean we're investing there. But it creates a lot of interesting guesswork, and we feel that the more we have to guess, the more we need to get paid. And today, in certain names, I would say we're kind of there. We're getting paid for that risk, but I wouldn't say it's en masse. Right? Hopefully that answers your question.
Yeah, thanks. So, Josh, how about you're getting lots in the States and globally? What are the sectors that are good for you that you think you're getting paid for the guesswork you might have to do? And is it more like a bottoms up analysis, or like Jimmy was mentioning, like alluding to a flow of funds where kind of money's flowing into these places and maybe the pricing is good or maybe it isn't?
My strategy has had to evolve over time, where I'd say my DNA has been quite value, and that for a bunch of years in the early parts of the last decade, like the 2010 to call it 15, worked extremely well. The reason why it worked extremely well is because everybody had this confidence in what NAV really was. You could find something trading at a discount to NAV. You could take advantage of a short-term dislocation. Even more so if you could find a company at a discount to NAV with a company that was going through some kind of positive change that the markets didn't want to give credit for right away, or if you had an activist situation, you knew what your exit was because of that confidence in the NAV. I'd say since the Trump election of 2016, when interest rates initially started spiking for a couple of years, and we had this like huge growth on mentality, all of a sudden the switch flipped, and confidence in what real NAV was just kind of eroded. So that value strategy just completely fell apart. And it was actually validated by some certain sectors like malls, for example, where NAVs on GGP went from 36 down to 30, down to 26, and eventually they got taken private at the 21, 22 bucks. And so a strategy of buying at a discount to NAV, just with your exit being that NAV, became harder and harder to find. So what's really switched for me in the last few years is trying to understand and appreciate that, one of the difficult things about investing in REITs, I think there's a lot of advantages of publicly traded real estate over direct real estate. But one of the disadvantages is that because of this instantaneous mark on your assets, your investor base, their time horizon shrinks. And you don't have the luxury of an investor base that comes in and that can stick to that 5-year time horizon on their view. So you do have to pay a little bit attention to what momentum is within the landscape if you're going to try to earn returns. Now the key is not to go and overpay for the risk of the price risk that you're taking on. But I think what's changed in this new environment with this lower yield environment is that all the stuff that looked expensive to me looks cheap now. When you run that risk-free rate through on global warehouse assets or data center companies, that initial free cash flow yield is something like 3-4%, but free cash flow growth is like a very visible 15%. In a zero rate world, that looks extremely attractive to me. So the strategy has been largely to stick to the sectors with continued strength and fundamentals until that breaks, where I'm not trying to guess on multiples, and I'm not trying to make the bet that multiples are too low and going higher, but that we can get the returns just by that free cash flow growth. And then where I will get into what I would call value or opportunities as they stand right now in the public markets would be that residential side, similar to what Jimmy was saying.
Yeah, just if I could just add, like Josh and I always sort of talk about this sort of value mindset and whether that is still applicable. If you look at data within the broader equity, and I know this is real estate, but we're talking general equity because REITs are a part, in my mind, most of the REITs are today in the value category. If you look at the last decade, you buy the cheapest and most profitable stocks. Your $100 goes to $170 last decade. And you buy the most expensive and least profitable stocks, your $100 goes to like something like 300, 3x, right? So it's like the strategy of buy low, sell high just didn't work. The strategy of buy high and sell higher actually worked. And so today, when when you look at that, but then if you go back 30 years of data, then value beats momentum of growth. So it's really it's intellectually interesting, but quite frankly, Josh is right. Like, investors don't have 10 years to wait, let alone 5 years. Don't have 5 years to wait, let alone 10 years. So I would say the happy medium, in my mind, in the real estate space today is the apartment sector, because I think when even when I think about it from a underwriting direct real estate perspective, it's much easier to underwrite the exit value of an apartment building than an office building today, and that matters, right? And in a low yield world, when your discount is that low, that future growth is worth a lot more. So the more uncertain that future growth is, the lower the value is going to be.
How about a more difficult spot like we've seen? There's Polo Park's Cadillac Fairview, so we got a lot of money for the pension plans that are in the large shopping malls. I don't know if we should be worried about pensions. I'm not an Ontario teacher, so that's probably not. But what do you guys think of the retail market, whether it's in Winnipeg or other centers like Toronto, Montreal, Vancouver, Calgary, and then down in the States? Like, how's that going to shape out? And I guess maybe specifically to Dennis, like the residential real estate around it, is it going to be like square one where you have all these towers around it, or is it going to be something different? Because are people going to congregate around these malls, or is it all just going to go back to normal once everybody's got their shot in them? So whoever would like to comment on that.
Well, hopefully it doesn't take 80 years, but or 100 years actually. But as I recall, we had the Spanish flu, the turn of the 20th century. So, and we came back and built really big malls and congregated. So at some point, this will be behind us, and we'll return to some semblance of congregation and density. What I would say, however, is that COVID-19 has simply accelerated in-place trends. There was too much retail square footage per capita in North America, arguably in Europe. And so that trend was going lower. And I can see it. I live in Southern Etobicoke in Toronto. And, there are 3 malls here. There was Sherway Gardens, Cloverdale, and Honeydale. And all 3 of them back in the day were similar price points, similar catchment area, similar tenant mix. And over the years, Sherway has gone high upscale. So they've got the Williams-Sonoma, the Starbucks, the Apple Store, the Tesla. Cloverdale Mall has sort of gone low to mid, right? So they did a huge redevelopment a few years ago, and so they've got the Kitchen Stuff Plus and the LCBO and the Tim Hortons, and Honeydale's gone, right? It was a bowling alley for a little while, and then it was a telemarketing location for a while, and now it's just shuttered and waiting for redevelopment. So you can see that trend, and what COVID-19 did, of course, was it took the weaker malls with weaker tenants and eviscerated them. And so you are going to see more bankruptcies, you're going to see more vacancy. There's wonderful narratives out there about malls being taken over by Amazon and turned into fulfillment centers or into industrial real estate. I can tell you that most malls are surrounded by residential real estate, and those tenants and those residents are not going to go for rezoning into industrial with lots of huge trucks coming in and out of their neighborhood, potentially increasing accidents and fatalities, and adding to the air pollution. So retail, I think, there was a poor trajectory before COVID-19. It's accelerated because of COVID-19. And I think on the other side, it's going to be challenged. And so when you're looking for places where you can see, strong cash flow growth driven by low vacancy, rental growth, and the ability to add value to continue that virtuous cycle, I'm not sure that retail is going to be one of those places where people are going to park a lot of capital for that. Especially if you compare that to the outlook for, as Josh said, cold storage, industrial, distribution, cell towers, data centers. From my standpoint, I don't necessarily have to have an opinion on everything, and I don't necessarily have to allocate capital to everything. And, if it's just too much brain damage to figure out how I'm going to make money here, I'm going to gravitate towards the places where I know with certainty I'm going to compound capital safely and at a high rate of return. And it's probably not going to be at retail.
Yeah, don't get brain damage, please. How about Don? How about like Winnipeg and retail market there?
Yeah, no, the retail market here faces the same challenges as elsewhere. The malls. One thing that we're fortunate being a regional city is we tend to be, have less retail per capita. As a company at P3 that focuses on development, I really think where we've been watching our trend lines since we started the company in 2010 is to follow technology. Technology is what's changing the demand for retail right now. You can buy everything from home. You can go to your favorite restaurant and eat from home. So the changes that we've always followed is to, watch those assets that probably should be demolished and not retrofitted because, as boots on the ground real estate people, my partners have all been ones of development minded fellow. I mean, at the end of the day, we follow technology trends, and we think, for example, that much of the Canadian marketplace for retail and apartment is probably under demolished as opposed to overbuilt. And I think that is the theme that you follow, and everybody on this call is follow companies that are making investments in real estate that can withstand shocks from technology. And unfortunately, retail in a lot of places has succumbed to those shocks because of the changing shopping patterns that technology, for example, has created. So here, again, the regional cities in Canada, I think you'll find less retail per capita. But look, the impacts on the office market, we'll see what happens over the coming years in terms of how many people go back to work. But there are a lot of companies even announcing this week that their staff's not coming back. Until those things work themselves through the system, it's going to be very hard to underwrite office building. It's going to be very hard to underwrite shopping centers. And lastly, just a last comment about retail. I also think there's a bit of a bifurcation that people aren't paying attention to in terms of what kind of retail do you own. If you own open air real estate, that's probably better than owning enclosed shopping malls. If you own open air shopping centers, then what do you look for? It's probably good to be grocery anchored or liquor or cannabis anchored. Cannabis has been a huge growth story for the retail sector. So there's lots of positives. Just look at what people own and look at what people are buying. Again, with our development focus feeding into our private REIT, we try to hit above market returns, and we do because we are building the new real estate that we think people want to lease.
Yeah, you can capture that other development improvement there too. That's cool. What do you guys think, like the risks and horizons? We've been through COVID, so that's, I guess, baked in, one can hope. Anything on the financing side, or what are the types of risks we're seeing? We got demographics, which of course have been shifting. I know Don, on a pre-call, you mentioned like the loan to value rates of CMHC had some money sloshing around and then stopped it. So what are you guys seeing there?
Yeah, no, I think that when you look at where you move forward from this, the biggest thing that I am concerned about personally is the economy and jobs. And how long people are told to stay home. We all have our views on the pandemic and how we should respond to it, but as long as there are highly desirous reasons to stay home and not work, again, our casual labor market is in trouble and will continue to be. We'll let the health experts tell us what to do. But if people aren't working, people are doubling up in their apartments in every city in Canada. If people aren't working and we start seeing vacancy, investors lose confidence in the asset class, and maybe capital starts to flow. And so, to me, the biggest risk, bar none, over the next 6 months is how does our economy get back into a functioning state to create jobs, to create people being back at work. And then as real estate executives, how do we pick and choose where we allocate our capital and what cities, what sector, and then what product type, existing versus new. It's going to be, I think, a very exciting next 2 or 3 years because ultimately the tenants are going to define what people want. And anecdotally, this development site that we have, this commercial development site we have in Winnipeg, it's in the suburbs. It's in a very strong location called Bridgewater, as an example. the demand that we have, we need an anchor tenant for our office building, our commercial flex building. These are all people that want to come out of downtown because they need to redefine their space, how people work, and they like the burbs because of parking and spatial factors. And so there is so much going on. I think it'd be a pretty cool time to be an architect or a designer right now and working with these tenants to figure out what they want.
That's cool. How about Josh? What do you guys see as risks to your portfolios? Like I say, there's Canada and global. What's the next pandemic?
I'll reiterate what Don said. The economy is going to be huge in this whole thing. But I would also say that it's the type of risk that I'm worried of is going to depend on the type of real estate you're in. Like the real risk to the stuff that I like that's doing really well is if COVID goes away faster than we expected, and if the economy returns to a new normal faster than we expected, and all of a sudden, that bottomless pit that those other sectors, the beat up sectors, find themselves in, if they start to catch a bid and money says, you know what, things are actually pretty good, then you could get a serious rotation out of those stronger asset classes into value. And we've seen it through periods over the last 6 months, but it hasn't been sustainable for a variety of reasons. But I think back to the health of the overall economy, one of the things that we're going to continuously watch are corporate credit spreads in general, because that tends to tie in pretty well to real estate assets, and it was corporate credit spreads that really led the way as they blew out of control in March through the pandemic. That really kind of foreshadowed where these asset classes were going to go, and they settled back in, and a lot of the right asset classes started to settle back in as well. So those are some of the things that we're going to watch out for.
How about you, Jimmy? What's the?
I hate to sound like simplistic, but it's the risk that I'm not aware of. That's what I'm most worried about. No one saw this pandemic coming, and it just threw the sector upside down, many of the traditional real estate sectors. And so it's those things. I think, when I think about the economy, there's so many complexities to the economy, so many variables in the economy that when, as allocators and trying to decide where to place money, it makes it very uncertain. It doesn't give you a whole lot of conviction on when you have that kind of a macro environment. So, because when you think about what's going on in the market, to me, there's like four things, right? Like as we touched on, what is the impact of this pandemic? And the question itself has a lot of multiple variables. Are we going to get a vaccine? Are people going to take the vaccine? Are we going to get a second wave, third wave, lockdowns, etc.? That in itself is very difficult to answer. And then you layer on, what is the government response to this pandemic? And that also has its own sort of series of questions that you need to answer. And then, as we touched on, the recession and how deep does it go? And then finally, rates. It seems to be that the consensus view is that rates are going nowhere. And even if it goes up, it's not going to go that much higher. That is the consensus view. And whenever there's a consensus view, you always have to not take it too much for granted. It probably is going to be the case, but it's certainly you got to be paying attention to that. And so those are the four key big macro questions that I think will have deep implications on what happens in real estate. And then the biggest one is, I don't know what else is going to happen. In terms of fundamental to what we do, I would say out of all of those, I think the interest rate question is probably the most important one, because that underpins, discount rates, and that has effect on values. The other thing I would say is, I don't know what the exact number is, but I think it's something like, if it's not 60 or 70% of the bonds are yielding less than 1%, the way I look at it is, the volatility of the space as expressed in the public market, I think is going to be very high for quite a while. When you're operating in an asset class with an unlevered return of 4, and you're trying to guess whether that 4 becomes 4.5 or 5, like that causes a lot of volatility, because you're at such a low discount rate. And so I think that's something that we got to live with over the next few years is this uncertainty of discount rates and the volatility it causes. So that's why, you know, I mean, this is a bit of a self-serving comment, but for all of us as active managers, I think that's why, you know, especially in a market like today where it's highly bifurcated and with increased volatility, it becomes that much more important to figure out where you want to be and where you want to play.
Well, you, Dennis, you by their nature, you're buying long life assets when you pick up an apartment block or, you know, other type of asset. Like what weighs on your mind when you're what do you look for, or is it kind of like Jimmy, like just whatever might happen, who knows what the risk is going to be?
Yeah, no, I think government/leadership is your biggest risk out there right now. And I think you're seeing that not just like we're Canadians, so we like to complain about everything until somebody else wants it and then it's awesome. But if you look in the United States, you're seeing a complete disintegration of their systems and their norms in the face of overwhelmingly horrible leadership from the top down. I mean, they're literally dying. And you've seen an over-politicization of all of their normal institutions. And so you can see the ramifications of that. So why I bring that up in the case of allocating asset, regardless of asset class, is one of the things that we were forced to do was take a step back when the pandemic hit and take a look at the balance sheets of various countries. Because, you know, I remember my last day in the office, I thought, okay, 2 weeks to 2 months and we're back in the office, we're all good. You know, we're 6 months going on 7 months into this now, and you're starting to really see government balance sheets balloon. And so the question becomes, which countries were better positioned to continue to replace corporate revenues and household incomes in the face of, you know, a shutdown of everything? And how long can you afford to do that? So you start looking at countries like Germany and Canada and the United States and New Zealand and so on and so forth as having superior fiscal situations going in. And they also had more serious approaches to dealing with the virus. And the combination of those two things means that, you know, you can complain about there being 823 new COVID cases in Toronto today, and however many thousand in Canada as a country. But if you start looking at other geographies and countries that did not have a systematic approach to this and did not have a better balance sheet going into this, you can see where there's going to be carnage. You know, some of these emerging market countries have got just so much coming after them now. They've got uncontrollable spread. They've got highly levered balance sheets that are exposed to US dollar debt in some instances. And so if the US dollar starts to appreciate again, how are they ever going to service this debt? And that feeds down into the rest of their economy. How are you going to be creating jobs if the government is struggling under its existing fiscal strain and companies can't generate any revenues on their own? So I think we're looking around the world for where leadership systems, structures are intact and working. And we think those are the geographies where jobs will be created, where economies will come back faster and more sustainably. And as a result, you know, real estate is inherently domestic, right? So as a result, those real estate markets should benefit from a faster recovery, better and more sustainable job creation, and a return to compounding cash flow growth, occupancy gains, and so on and so forth. So, you know, leadership at the government level, some of it at the corporate level, but leadership and government are two things that I think right now are at a premium. And so that's what we're looking for.
Yeah, I think back to my, I guess, Econ 102, you know, MV is PQ. So we had the velocity of money has been dropping since the 90s, but now dropped precipitously. And, you know, your GDP dropped by, I think, well, we're looking at 20-30% for a lot of countries like Canada, US. And so you have to replace it with just cash, right? So the US put out $2 trillion, they minted $2 trillion worth of platinum and just sold it themselves. So we did the same thing. We did about this. And so you got to prop up the money supply. And this happened 10 years ago. Remember, like 12 years ago in the crisis, they're putting so much money, it's going to lead to huge inflation. You should buy gold and all these other things, and horses probably in that, you know, because you never know. So what do you? So, but it didn't happen, and the merry-go-round kept going because you know the U.S. has this Triffin dilemma, and the FX is like they're the reserve currency. They can do whatever they want until they don't, but until they don't, it just keeps going. And if everybody raises that much money, like 20% of GDP a year, everybody's in the same boat. We all become Japan, and that'll affect. But then to the real estate side, they have to keep interest rates low. Interest rates cannot rise, as you said, Dennis, like, because they will have to pay huge amounts in interest payments, or just literally run out of cash, or just keep on printing, and then it just starts to accelerate. We're in the Weimar Republic then. So what do you guys think about that fantastic scenario?
To your point, James, and to bring in what Jimmy was saying earlier, let's assume that the Fed's forward guidance doesn't hold and that they can't keep rates at zero until the end of 2022. Any increase in interest rates would be felt first and foremost by countries or companies that are already highly levered and don't have exposure to assets that have the ability to retain their tenants, their cash flows, and absorb an increase in their debt service payments. So again, that comes back to which countries were in better fiscal shape going in, have maintained fiscal flexibility. And for companies, this is 101, right? Who's got a lower levered balance sheet, a more sustainable balance sheet that can absorb shocks like this? So for us, it really hasn't changed the way we underwrite things, other than adding that additional step of saying which countries are not going to implode in the face of an extended COVID shutdown. The rest of the due diligence and analysis is the same.
How are you guys on? Oh, sorry.
I was just going to ask. I agree. Like, rates are probably going to stay low for a while, but it's very scary when you think about. And if you ask all the REITs or all the landlords, and you say, hey, just sensitize your cash flow for a couple hundred points increase in your interest rate. And I think the number is staggering in terms of how many would be upside down in their cash flows. It's quite amazing. And so that is to me is the biggest risk. Probability of it happening, I don't know, probably not very high, but
probably up there with a global pandemic, Jimmy.
Yeah, but exactly. But it's scary how levered we've all become. Households, consumers, companies, and real estate companies.
So one nice thing about cities is they can't lever, so they got to have balanced budgets. So going into it, obviously, if you had a really robust and pandemic, anti-fragile type of economies, you do well. So in Canada, we'll stick to that, and then for Don, we'll decide like which borough of Winnipeg do you like best. So where do you guys, which cities do you think did best go up until this, and where do you think, which do you think are the best places for new money for investments? And if you want to pick a sector in there, it's probably going to be multi-res, but if there's a sector in there that makes sense of the centers that we have across Canada.
Yeah, no, clearly. I mean, we still have a huge bias for our local market. We still think there's a tremendous amount of opportunity here. Back to your question about opportunity, I think specifically from a real estate, boots on the ground perspective, which again, we are as a manufacturer of real estate. I think there's two pretty important themes that Canada needs to focus on the next 2 or 3 years, because we could all drive ourselves crazy talking about COVID and government spending and what's right and what's wrong, but that's all political and I can't control any of that. The two trends are immigration. Canada has become a country of immigration, and since COVID started, the student immigration may not be off a lot, but clearly the business recruiting immigration is. A lot of companies locally aren't bringing in those people from wherever in the world for some of the skilled labor that we need. And the second is our First Nations communities. In Winnipeg specifically, they just got control of a site called the Campion Barracks. It's 140 acres. And so I think real estate companies that can tie into those immigration patterns and either buy and renovate or build real estate that ties into those, they're going to be winners. And also those that can forge positive working relationships with our First Nations communities. We haven't been able to do it yet. We try, but they control a lot of land, a lot of very good land right across Canada. So, we have always liked, the peripheral communities in Vancouver. We love the Greater Golden Horseshoe in Toronto. Again, why? Those areas are really driven by some of those immigration patterns. Vancouver and Toronto are two excellent international real estate markets, but they are very expensive.
Yeah.
And if you're not in real estate, just so you know, in the pandemic, pricing in those markets for good quality assets has not gone down. If anything, it's probably strengthened. Cheap interest rates drives that. So, we're going to continue to focus on built for rental apartments. We think the way people rent apartments is changing and what they demand out of them is different. And we still love tactical street front commercial real estate. Not a big fan of owning a regional mall, but I love 10,000 feet on Yonge Street in Toronto. I would love 10,000 feet on Granville, because those smaller bay, and I love 10,000 feet on Academy Road in Winnipeg. Those small bay properties are going to be the drivers of new format restaurants, which might just be pure takeout. They're going to be drivers of professional services, chiros, orthodontists. Medical clinics, doctors are getting pushed out of hospitals. So there's lots of opportunity in those two sectors in all major cities in Canada. And again, watch immigration, watch those patterns, and watch your First Nations communities, because I think there's going to be a lot of good business for us as real estate managers to be done in those sectors, driven off of those themes.
Great, thanks. I've got about 4 minutes. I don't have any questions in the Q&A. I think maybe we're just covering everything so well. So we'll have to portion out 4 minutes between 3 people. This will be fun. Let's go to Jimmy. What cities do you like in Canada? Vancouver, Calgary, Edmonton, Winnipeg, all these places that have some of the excellent fundamentals behind them. And then think about pricing.
Fort McMurray.
Oh yeah?
No, I don't know. It's no, to be honest, it's hard to see, if you're going to go back to the thesis of density being the enemy today, and that ultimately, we don't think that's going to be an enemy tomorrow.
Mm-hmm.
Then it's hard to argue how right now, I know, for instance, and this is, condo rentals rents are down something like 15% from last year. Brand new multi-family purpose-built rental in Toronto, downtown Toronto, probably down 20%. So there is definitely pressure there. I got to believe that on the other side of this pandemic, I don't think downtown Toronto will be dead. So, the risk-reward profile is tilting a little bit more to reward today. So, I'm going to stick to in Canada, there's only a few cities. It's not like the US where people migrate to the Sun Belts. There's no such thing in Canada. So I think I think the density that we've seen over the last multiple decades, interrupted by the pandemic, will continue. So I stick to the big urban cities.
All right, cool. We got Winnipeg. We got big cities. Joshua.
Oh, and Winnipeg.
Oh, okay.
Thanks, Jim. I'm going to take the other side and say I'm a fan of secondary cities for sure, maybe tertiary. And I don't think that, this density is the, I grew up in Thamesville, Ontario, so I got to get some.
I'm from the Paw, man, so I know the 10,000 people, so yeah.
So I don't think the density is dead thing is detrimental for the big cities, but I think it can actually be incrementally positive for smaller towns. And what I mean is you don't need to lose a ton of population out of the big cities to make a really big impact in some of these smaller towns. I think the work from home thing, the work remotely thing is just going to enable that for a lot of people who are, I think, permanently going to value space more than location. When you get into an environment where we're on rocky ground on the economy and rents are eating up so much of people's wallets. And so I think there's a lot of good options in the secondary and tertiary cities. From an investment standpoint, if you can buy something at a 5.5 cap rate, that's less sensitive to a 50 basis increase in rates than something at a 2.5 cap. So I would say that I'm a fan of secondary markets.
Cool. So we've got Winnipeg, big cities, and Winnipeg. Secondary, tertiary. Dennis, where are you?
Jobs. Okay. Actually, I'll say Don and I can legit say Winnipeg since we both actually got development there. But what I would say is jobs. When everybody talks about real estate, they always say location, location, location. It's jobs, jobs, jobs. Where jobs get created, people move to, which creates a demand for places to shop, places to eat, places to worship, places to go to school. So wherever job creation is most robust and sustainable is where I would want to allocate capital. And Jimmy's correct. There are 6 MSAs, metropolitan statistical areas in Canada with 1 million people or more. In the United States, there are 54. So the Canadian market inherently is more stable and predictable from a migration pattern, from a job formation pattern, from a capital compounding and growth standpoint than is the United States, right? I mean, 50 years ago, if you were building a car in the States, you were doing it in Michigan, you know, with steel from Pennsylvania. Now, if you're building a car in the United States, it's aluminum and it's in, or carbon, and it's in Alabama or in Mississippi. And, you know, Jimmy's right. There's a sun belt that people migrate to every now and then, or at the end of their productive lives, right? So inherently, the United States is a much more volatile, higher growth potential, higher depth potential, but it's a much more volatile market over the long term and over the cycle. So for us, you know, we prefer markets that are more constrained, you know, have got a little more transparency and predictability, and where job growth is better than, you know, whichever benchmark you're using, national, regional, global, what have you. So jobs, jobs, jobs. Wherever jobs are being created, that's where we want to buy real estate.
That's awesome. Thanks. Yeah, we don't really, we have Sunshine Coast. We can't really go that far north. So yeah, that's interesting. Well, speaking of depth, tons of depth on this panel. Thank you very much, Dennis, Jimmy, Don, Joshua, all of us meeting online. At some point, we'll all get together, you know, all take planes to Richardson Airport and enjoy the Winnipeg life for at least a couple days. But that'll be, I don't know when, a year? Vivek will tell us when. Thanks a lot.
I don't know if I can tell you that, but yeah, I'll echo what James said there and just say thanks to you all for a really interesting discussion. Obviously, we have no guarantees what the future holds, but it's always great to hear the views of investors that have as much experience on their sides as you guys all do. And I'm sure I speak for everyone who's here in saying that we took something valuable away from the discussion, and we hope you're all able to join us again in the near future. Now, on behalf of all of you, the CFA Society Winnipeg is going to be making a small donation to the Winnipeg Foundation. So thank you again for that. And I also have to throw a thanks out there to Sid Doohan and Eva Swan for helping to get this event on its feet. And thank you everyone who was able to join us. I know we're a little over time, but that just means you got a little bonus information. So thank you for taking the time to virtually attend today. We're going to keep these virtual events coming through this second wave as we just keep on waiting for a return to semi-normal where we can all meet each other in person again. But in the meantime, we hope you all join us again, and take care and stay safe.
Thanks, Vivek.
Thanks,
Thank
everybody.
you.
Thanks, everyone. Good seeing everyone.
Bye-bye.
All right, bye.